Hi, I'm Sumit Desai, Senior Fixed Income Analyst with Morningstar's Manager Research Group. Joining me today is Fran Rodilosso, Senior Investment Officer for Fixed Income ETFs with Van Eck. Fran, thank you for joining me today.
Thanks, Sumit. Thanks for having me.
We're here today to talk about the Fallen Angels High Yield Bond ETF. Can you talk a little bit about what a Fallen Angel is and the role that a Fallen Angel bond or issuer plays within the high yield market?
Sure. Fallen Angels are bonds that were originally issued as investment-grade bonds. So the issuer typically has gone through some type of credit issue that's led to a downgrade or series of downgrades that's brought the bond into the sub-investment grade universe. Interestingly, Fallen Angels are bonds, not the issuers themselves. So if an issuer issues a bond after their credit rating is sub-investment grade, that bond would not be considered a Fallen Angel. How do Fallen Angels fit into the general context of the broader high yield market? Well, they were the original high yield bonds. The original junk bonds were Fallen Angels. Today, they make up about 13% of the broader U.S. high yield universe. So there's a lot more original issue high yield out there now than there are Fallen Angels.
Given your comments, and sometimes a bond will become a fallen angel if there's a deteriorating credit quality issue, what makes this segment so attractive for investors?
Yeah, well, what happens is there's usually some type of credit deterioration, true, that has led to the downgrades. But consistently, fallen angels have remained in the double B category. So versus the broader high yield market, it's generally remained a higher quality segment of the high yield universe. Also, there's a little bit of a value proposition in how it all plays out. In other words, as credit rating downgrades are anticipated by the market, usually those bonds lose a significant amount of the value that they're going to lose by the time the downgrade actually happens. So by the time they enter this index, which is the month after the downgrade that puts them into the high yield category, the bonds have typically lost, I think Merrill Lynch did a study once, about 80% of the value that they lose in total. Mm-hmm. But a key component is just today the Fallen Angel Index is about 80% double B issuers, double B plus, double B, or double B minus, but issuers with two Bs versus about 47% of the broader high yield market.
It seems like there could be some heightened credit risk if the deterioration is worse than expected. Can you give an example of some of the types of companies that fall into this category? So
there are some very well-known companies, and that's one of the qualities of Fallen Angels. Typically, they were an investment-grade issuer, so they may be a firm that's got a long-established history, a large asset base, et cetera. So some well-known names today that are in the index: ArcelorMittal, which is a big global steel company, is one of the larger names in the index. Some smaller ones that are still well-known: JCPenney, Dell, Sprint. A very well-known fallen angel from about 8 years ago that reemerged and became investment grade again was Ford. Okay. Now, JCPenney, by the way, is one of those companies that you mentioned that had continuation of deteriorating credit quality. It's no longer a double B issuer.
So to that point a little bit, obviously what drives returns for the high yield space over the long term is really going to be dependent on default ratios. What is the default profile for a fallen angel bond relative to a regular high yield bond? Right.
So you take a 30-year history or so. Edward Altman does great studies on histories of bond defaults. His 30-year history of fallen angels puts it almost a percent below the average annual default percentage for original issue high yield bonds. Original issue high yield bonds are somewhere around 4.5% annual default rates on average, and fallen angels are more around 3.6%. According to Altman's numbers. The last few years, neither category, original issue or fallen angel, have had very high default rates at all. Sure. Below 1%. Mm-hmm. We're in a fairly low default rate environment. Probably more importantly, or as important, fallen angels have had a higher ratio of becoming investment grade again than original issue high yield. So they've defaulted less on average historically, and ascended to investment grade at a higher rate on average as well.
When investors want to look at this segment of the market going forward, you mentioned that a big portion of the benchmark is within that double B tranche, and that's generally known as an area where it's a little bit more interest rate sensitive than lower quality areas. So how do you expect this to react in a rising rate environment?
Yeah, very, very fair point. There should be a higher sensitivity to interest rate movements, particularly in the 5 to 10 year range of, say, Treasury moves, which doesn't necessarily correlate with moves in Fed funds, for instance. So in a rate hike environment and a curve flattening environment, the high yield in general may do okay, and so may fallen angels. But also, by the way, since many fallen angel bonds, well, they're all original issue investment grade, many were issued at longer than 10-year maturities. High yield bonds, original issue bonds, are usually 10 years and in. Mm-hmm. So the duration on the fallen angel index is a little over a year longer than the duration on the broader high yield market. It's in the mid 5s versus the mid 4s. Mm-hmm. So higher interest rate sensitivity from that perspective, and from the perspective of tighter spread in the double B category, so lower cushion. That being said, both the broad high yield market and fallen angels over the last 5 and 10 years have shown a slightly negative correlation to 10-year yields or the performance of 10-year treasuries, and a slightly positive correlation of performance of 5-year treasuries, but near negligible. I think when you talk about higher interest rates today and things that may happen over the next year, if you have something like a taper tantrum and it's a risk-off reaction to the prospect of higher interest rates, that's a different impact from the direct impact of higher rates. And risk-off is generally not good for high yield, sure, broad market or angels. But there have been 4 or 5 years since the angel index came into existence where either Fed funds or the 5-year yield has increased by more than 1%. Each of those years, both the high yield market and fallen angels have actually had positive years, and fallen angels outperformed the broader high yield market 4 of those 5 years.
One of the concerns across high yield as well, we've heard about over the past few months, is exposure to the energy sector. With falling oil prices, a lot of energy companies that issued debt at higher oil prices, and that's affected the market. How does the sector exposure within energy compare within the fallen angel world? And where are the other kind of large sector exposures within the portfolio today? Good
question. And the sector exposures definitely change over time pretty dramatically in the fallen angel index, because if an entire sector is going through a period of distress, you may see a large number of fallen angels. Before we get to energies, quickly back 2005, 2006, automotives, I mentioned Ford earlier. It wasn't just Ford, there's a lot of the finance companies too, became by far the largest sector within the index. In 2012, financials became mostly subordinated bank issues by big U.S. banks, became about 30% of the index. But back to energy, today it's about 11.5% of the fallen angel index versus roughly 14.5% of the broader high yield market. A year ago, it was 4.5% in fallen angels and about 18% in the broader high yield market. So there's capital loss in the sector. Sure. In high yield, that brought the weighting down. What's happened in fallen angels is several new energy companies have entered the index, the largest being Transocean, which was downgraded to sub-investment grade status earlier this year. So at 11.5%, it's catching up. I guess the good news is it's been catching up as bonds have been losing value. I would expect a few more energy fallen angels before the year end, so you'll probably see a similar weighting in angels versus a broader high yield market by the end of the year. Okay. The other large sectors, by the way, basic industry, where something like ArcelorMittal would fall into, is about 20% of the index. Banks are the next largest sector in the high teens. And then energy and telecommunications are in the low teens.
Okay. Given the wide variety of options investors have in terms of accessing the high yield market, how do you think the best way to use this fund, or what would you suggest is the best way for investors to use this type of ETF?
Right. I think there's a value proposition within the fallen angels that we talked about earlier. Sort of the two things. I think the tendency for fallen angels to have lost a lot of their value before they enter the index, so sort of buying the news. Number one, and number two, the higher propensity to come back into the investment grade world, which gives some capital appreciation potential. Also, think of it as close to crossover, the triple B, double B segment with that value proposition. So for investors who still want exposure to high yield, but may be willing to give up some yield for the higher credit quality end of the spectrum, I think this is a good choice. So I think use it as a substitute, maybe an overweight within your high yield allocation overall.
Fran, thank you for taking the time to join us today.
My pleasure, Sumit. Thank you.